The market or the candlestick signals tell you when the market is going up, it tells you when the market is going down, and it also tells you when it's going sideways. Going sideways is just as important information as knowing whether a trend is going up or going down. The reason for that is if we see that we have a high probability of an uptrend, obviously our portfolio is going to be relatively long. If we can see that they've finally broken it down and heading in a downtrend, obviously the portfolio is going to be relatively short. But in a sideways market, that gives a different dimension to our scanning, which is that we're going to find positions that are going long and positions that are going short, not knowing whether they're breaking this market to the downside or whether they're breaking it to the upside. At least having long and short positions in the portfolio will kind of still be profitable. May not be nearly as profitable as having all long positions going up or all short positions going down, but it still provides a very good profit center. And as can be seen in the Nasdaq, this one's been fading off. So there's been good situations where the shorts are working very well, especially in Nasdaq stocks, and long positions are working very well in specific sectors. For example, our recent recommendation on EXH was based upon that we could see buy signals in the oversold area and a doji sandwich coming back up through the T-line, also performing a possible J-hook pattern, which it's performed very well, even though the market's been flat. Once again, patterns work extremely well because they are the accumulative knowledge of everybody buying and selling, and when these patterns are developed, they're still developed based upon knowing which way the market is going in general. That same scenario works on the short side, as we saw in our recommendation to be going short WYNN resorts. Once you saw a sell signal and a close below the T-line, you stay short until you see a buy signal and a close back up above the T-line. In this case, we're starting to see a potential reversal signal. Makes the closing of a short position very easy. If they open this positive after a hammer signal in the oversold condition, at least we know they're probably going to pop it back up here to the T-line, the 8 exponential moving average, this black line, and that means we want to take profits. The worst case scenario is we take profits. It fails at the T-line. We can always re-short. And it doesn't matter what market you're trading. The lean hog trade has been very strong. Wave 1, wave 2 of a J-hook pattern, starting into wave 3. This is where you take profits, this is where you go short, and this is where you reverse your position, because what does human nature usually do? Usually a strong price move, profit taking, and then the continuation of that strong price move. Essentially, the patterns allow a candlestick investor to see, just like a roadmap, where the buying has come in, where the selling has come in, and where the buying has come back in to complete the pattern. That'll be it. We'll see you in the chat rooms.